So, hello and welcome to One-to-One Mining Investment. Today we're going to be talking about COVID-19's impact on mining private equity. And we have three expert panelists to talk about this subject. We have Matt Fifield, who is the managing partner at Pacific Road Capital, based down in Sydney. We have Bert Koth, who is the managing director and partner at Denham Capital, based in Perth. And we have Damian Pearson, who is investment director, corporate finance at EMR Capital, based up here in Hong Kong. So, gentlemen, very good to see you here today via the magic of Zoom. If we could just start things off, I'd like to talk about your portfolio companies, maybe. If you could just give us an update on how they're faring. What has been the impact on your companies? Bert, if we can start with you on that one. How are they faring?
By and large, I would say the impact is not as dramatic as we thought as a starter. I would say that 2/3 of our portfolio companies are not really impacted. I think where we have seen impact, one extreme example is Peru, where we basically were ordered to close down, right? But that is rather the exception. Our Chilean assets continue operating. Our DRC assets, BCA or Denham continues operating. Those assets that are still in development stage that require third-party financing, we are actually surprised that the third-party financing markets are actually quite receptive. So we got several of these processes ongoing at the moment. So I would say the impact in the beginning, when COVID-19 broke out and the world went into lockdown, we were quite concerned what the impact on the portfolio is going to be. But I have to say, it's turned out by far not as dramatic as we thought it could have been. Yeah, in some of development projects, there's a few delays, but nothing dramatic actually in our portfolio. I also note that the exchange rates in certain commodity currencies have really collapsed, like the Brazilian real. That's, for example, very helpful as we are just basically starting to construct a large mine in Brazil. So we were actually able to lock in by hedging a very low exchange rate on the Brazilian real and actually reap a capex saving versus what we have in the feasibility study as a result of that. So funnily enough, there was actually also a positive impact, right? Now, ultimately, under the bottom line, I think the impact is clearly net negative, yeah? And it remains to be seen how meaningful the long-term demand destruction is going to be or not, because the jury is really out whether the world is going to recover at speed, thanks to kind of infrastructure stimulus, in which case we'll see a somewhat steeper recovery, or whether it's really going to be a defect, an L-shaped or swoosh recovery, which is going to take a long, long time. So the jury is still out which of those scenarios is going to pan out. And obviously that will have a significant impact on the metal prices. But I would say, at least where I'm sitting today, it's not as bad or dramatic as it could have been. That's how I feel about it.
Are there measures that your companies have put in place to sort of keep things going or to ensure sort of safety on site?
Absolutely, absolutely. So we have, for example, in Africa, we know, because it's become more difficult to rotate people, we have our staff on site for a long period of time. Yeah, and that's a huge sacrifice that people make, right, for not being able to rotate in and out. But I think it's fair to say we look very well after all of them.
Absolutely. Damian, if we could move to you, tell us a little bit about how your projects are coping.
Sure. Look, I think it's a similar story. I think that our operating assets have continued to operate throughout this period. And when, we initially started looking at COVID-19 and thinking that the impacts you could have, it could be on site closures, it could be infections on site, and we haven't seen that. So certainly on-site operations have continued. People have had to make sacrifices, such as our asset in Zambia. People are staying on site for longer, etc. But the impact has been limited to those operations to date. Now the next point is what about the sort of price environment, which has clearly been more challenging in the copper and coking coal space, and we've certainly seen a material price decline in those commodities since the beginning of the year. And that's obviously necessitated some changes to operations and looking at more efficient operations, etc. So we've certainly seen that impact. But even today, you've seen some recovery in the copper price, back around sort of 255. So again, not sure what the long-term outlook will be. We are still positive, but the jury's out a little bit.
And even you've got operations in places like Spain, which have obviously been pretty badly hit by COVID. No impact there on the day-to-day operations?
Our asset in Spain is obviously a development project. So the office has been closed, but it's obviously very different, with a development project versus an operating mine site and the considerations you've got to make for that. So you're absolutely right. People have not been in the office in Spain. Working remotely, which is much easier to do, obviously, in development type projects.
Absolutely. And Matt, how are your projects faring?
Sure, Leo. Thanks for asking. Look, let's start for a second. And the very first thing that happened was we looked internally and we said, are our own people safe? Are we able to function? Fortunately, we have the technology solutions and the type of work where you're able to work remotely. Then immediately, as we started engaging with our management teams, our first lens was health and human safety and wellness, first for our workforces, and then radiating out from our workforces into their families and communities, and what part can we play in those roles. And then once you move past the health and human wellness dynamic in a situation like this, your mind immediately turns to how robust are we financially. And can we, you just don't know in these situations how events will unfold. So what you saw across our portfolio, one of the advantages of working with a company like Pacific Road is that all of our companies were cashed up and had pretty reasonably strong balance sheets, and that enabled us to both I think move through some of the health and human wellness factors, and then look towards how do you want to make sure that you continue to be viable, commercially viable, and operate. I'll pause there for a second, Leo, because I think that one of the things that's really interesting about today's environment is that when you look at previous pullbacks, say around the GFC or particularly around 2012 and 13, across the industry, balance sheets in general are far, far stronger than you would have seen at any other point in time. And what that means is that there's a low level of absolute distress in an acute environment like this. So, where goes the mining industry? I think goes a portfolio to some degree, and we were no different. We were, strong balance sheets. We did have isolated shutdowns that happened. And probably one of the other remarkable things about this environment, when you think about the pandemic, is you had simultaneous shutdown of supply and demand. So, and it's this remarkable synchronization where things didn't get too out of phase in terms of stocks. And so it's just now, as we're seeing our operations come back online, people are getting a sense of the medium-term demand, that you're seeing some of that imbalance in how, supply and demand fit with each other in the short term, and what that's doing for inventories, pricing, and so forth. But so far we're pleased. We have one company that's ended on extended care and maintenance, and the rest continue at pace, much like Bert and Damian.
And you must be sort of quite pleased to see that places like China seem to be getting infections under control and are getting their economy up and running again.
Well, look, there's been a variety of responses economically, and obviously China plays a huge portion, a critical piece in this focus of demand. So as Chinese economics and pull-through have come through, that's also, we've been watching that inside our portfolio companies. Now, one of the things that's been surprising is that, again, for some of our operating companies, we've seen just very steady, unaltered demand. And when you would have expected more of a wrinkle, that makes us intuitively cautious. Is there something that we don't understand? Because, hey, the world stopped for a little while. And so when the world stops, but demand continues unslaked, is that going to balance itself out? So I'm not sure how that's going to eventuate. I just know that it's a risk factor that we're looking at right now. And we're pleased to be seeing things, at least here in Australia, go back to normal very quickly.
Which commodities were those that where demand didn't slack off?
Really GDP facing and industrial minerals, those types of commodities just kept on moving through. When you compare and contrast that against news that we heard across iron ore and coking coal and steel demand hitting very sharp 1-2 month declines, it was very different. And some of the questions that we don't know the answers to for these less visible commodities are, is this intermediate supply chain stocking, or is this continued pull through of demand? Hard to know the answer. At least, as we look what's in front of us right now, we see continued strength.
And I guess also, obviously the strength of the gold price over the recent weeks and months must give you sort of cause for optimism. I know Damian and Matt, you both got gold companies.
Well, look, I think each of us could talk about gold, and at the end of the day, when you think about the role that gold plays in a deflationary or potentially sharply deflationary environment, people are looking for safe haven. In an inflationary environment, they're looking for that kind of real money aspect of it. And so it's playing a remarkable both ends of the risk spectrum. And the part that's in the middle is where that kind of more GDP facing, industrial assets and energy metals and all of the rest sit in the middle in a recovering world. So gold's been on a terrific run. We think that run's actually just getting started. Principally around the solution of a very uncertain medium-term economic outlook. If you look at the range of consensus estimates, it's never been wider.
Absolutely, Damian, what are your thoughts on gold?
Look, we're very bullish on where the gold price will go in this environment. You're seeing, just huge economic stimulus. So, just on the back of that, you can anticipate, I think, or certainly we do, further strong, gold price environment.
Absolutely. And as we come out of the crisis, what are your expectations for, infrastructure spending and things like that, which might have an impact on some of those industrial commodities that you mentioned just now?
Well, we strongly hope so. I mean, especially those of us who have significant metallurgical coal exposure are certainly going to be big fans of massive infrastructure stimulus packages. But I think we'll see quite some of those coming through. Certainly, the indications are from China that's gonna happening. Some of our off-takers also tell us that India is preparing, once they get out of this COVID-19 shutdown, for some massive infrastructure build-up. Obviously not in the same intensity or consistency as it has been executed in China, but there's certainly a willingness to meaningfully rejuvenate the infrastructure in India, which would be very good news for everybody who's got metallurgical coal and
issue. Sorry, but just now you had a bit of a connection issue.
I was just saying there are also indications that India will embark on a meaningful rejuvenation of its infrastructure, and that would also be very good news for everybody who's got iron ore and metallurgical coal exposure.
Fantastic. And obviously copper may benefit from large-scale infrastructure investment.
Sure. I mean, look, I think long term in many metals and minerals, there is a positive net demand trajectory, right? Because, I mean, it may well be that supply deficits like in copper are going to be pushed out further into the future, but eventually they are going to occur, right? Because the mined grades are getting lower, the deposits are gradually going to get depleted, and there's hardly any capital flowing into successful exploration or development at the moment, right? So at some stage, the rubber got to hit the road with a supply side cost price recovery. But I think, given everything that we know so far about the post-COVID-19 world, that day for sure is being pushed quite meaningfully into the future, but it's going to come at some stage.
What is our panelists' take on the idea that we may sort of try to rebuild greener after this? I know the EU have made some announcements which say that, you know, when a lot of their recovery spending is going to be directed towards, you know, green projects, renewable energy, things like that. What does this mean for metals and mining?
Bring it on.
Matt, what do you think?
Yeah. Well, look, I'm happy to take that question. I think that, you know, right now, one of the things that's happening in the world, Leo, is you're seeing that breakup between, you know, the U.S. and China accelerate. We saw the beginning of deglobalization in 2019, and it's really just been more and more of an acceleration. In the West, anti-China rhetoric realistically hasn't been higher. And it's not just U.S. versus China. Europe is trying to assert its own industrial strength and might in this. So you've got three parties that are all looking upstream. And as they look upstream, people are, you know, when people talk about supply chain resilience, what they're talking about is, in my mind, they're talking about our sector, control over trade flows, control over resources and processing. And so that, you know, so on one hand, you have geopolitics. Now, to answer directly the question that you asked, everybody has just gone out and spent an enormous amount of money to keep people happy in their homes and to slow the economies. And our view is there'll be many more rounds of stimulus. The next one will be pointed at the consumers. It won't work. People are scared, tired, you know, however you want to phrase it. It won't work to the degree that people want. Finally, that shifts into a very, very directed sense of stimulus. And that points ultimately towards nation block and nation building activities. And we think that within the critical and strategic minerals and within battery minerals and energy supply chains, these are going to be absolutely the areas that these nation blocks are trying to assert themselves, because ultimately the control over those supply chains lead to control over the technology and therefore the industry and jobs that in a circular fashion help pay for, you know, all that's gone on and will go on.
And as you mentioned, obviously, you know, there is a lot of tension at the moment between the US and China and Europe and China. And given that China has, you know, traditionally controlled much of the critical mineral supply chain,
right?
You know, Europe and America are going to be keen to develop their own independent supplies of those minerals, which means heavy investment into the mining sector and processing sector.
And I think it's going to be across the entire mining sector. That's what Bert was talking about when he said, bring it on. You know, and when he was talking about those macro events of general underinvestment, I think the next 5 years are going to be some of the most exciting years in metals and mining possible because of some of this dynamic that's playing out.
But a related question to this, given that, you know, recent studies have shown that, you know, solar and wind coupled with sufficient sort of battery backup systems can be price competitive with coal, if not cheaper than coal-fired generation, certainly new coal-fired generation. What's the future for thermal coal? Does it have a future? Can it be, is it something anyone would want to invest in anymore?
Well, as a starter, we don't invest in thermal coal, right? But that's ALP driven, right? But I think a lot of other funds as well who don't want that. We do believe it's a market that's seen its peak. It's going to be around for a long, long time, but it's seen its peak. But I just want to make a comment before. It's not just in critical minerals. It's not just about establishing control over the upstream, right, by nation blocks. That's maybe only 20% of the story or 25% of the story. Maybe even more critical it is to actually establish control over the technical IP over the downstream, because that's much more difficult, right? Because you need lithium processing plants, you need rare earth separation plants, you need magnet factories, right? If you're as a nation who strives to supply independence, if you have the greatest deposit in any of these metals on Earth, right, and you don't have the downstream chain, you still have no supply chain resilience. I think that's very important to mention when discussing all these kind of critical minerals and metals, that the upstream deposit is actually only a small part of the overall story. There's actually, after that, billions and billions of US dollars of downstream investments that are required to actually really establish nation proprietary supply chains. But
I agree with you, Bert.
Right.
yeah, but overall,
And are any of you guys looking to invest in those downstream projects?
It's not our forte. I can't speak for anybody else, but it's not our strength. And our experience as a fund manager is when you do something that's not sitting up straight up your alleyway, if you try to learn new things with your own and the investor's capital, it's a great way of losing money. So diversifying into downstream, it's definitely not our game because we don't have the expertise, right? We're simple people. We're financing the stuff coming out of the ground, and maybe one stage processing the concentrate, and that's where it's gonna stop. So frankly speaking, this is high execution risk to build these downstream chains. This is where governments will have to step in if they have the supply independence. Because if you combine the execution risk with the massive capital required and the IP intensity of most of these downstream chains, right? There's well a possibility there's not sufficient private capital in the room to shoulder that execution risk. I think this is where governments will have to step in, my private opinion.
And Damian, what's EMR Capital looking to do as we come out of the COVID crisis? What areas are you looking to invest in?
Yeah, sure. I mean, maybe just to pick up a couple of those comments from before. I mean, we have a similar philosophy. We're focused on the upstream, and we're retaining our focus on the 4 key commodities which we have been focused on. So that's copper, gold, coking coal, and potash. And we've not changed our view on the long-term dynamics of those commodities, and we're continuing to look to invest in them.
And obviously copper set to benefit from any sort of future green infrastructure build.
Yeah, absolutely. And then you've got the whole EV space as well, and that's got to pull through for copper as well. So we see exposure, our exposure to copper as being directly relevant for that.
And your potash investment, I mean, are there any feelings within the company that I mean, obviously at the beginning of the pandemic, there was a lot of concern over food security with some panic buying going on. The sort of global food security question doesn't really go away. So is that part of your thinking with the potash investment?
I think there's a couple of things I'd perhaps say. We're probably focused more on operating assets than developed assets, with the exception of what we're doing in gold. So at the moment there is perhaps the availability of operating potash assets is obviously a lot lower. But I think the whole sort of security, whether it's as we were just talking about, whether it's sort of security of supply chain, I mean, it applies as much to potash as it does to other minerals and commodities.
Absolutely. And so to follow up on the earlier discussion about how your companies are faring, how does managing your current portfolio through these difficult times sort of distract or impact your pursuit of new opportunities?
Not at all. Not at all is the answer. Mm-hmm. It doesn't. I think the big obstacle is on a new deal, you can only go so far until somebody needs to jump on a plane and carry out technical due diligence, right? So I think that's the real issue. The balancing the existing portfolio, time consumption versus new deals, that's our job. We always have to do that, right? So COVID-19 isn't any real different here. That the interesting thing is what we are doing here, like via Zoom and video conferencing and WhatsApp calls here, you can cover a lot of commercial ground by doing that. Yeah, you can probably remotely conduct a lot of negotiation these days, but ultimately you gotta look under the hood to see how the thing really looks like. So ultimately, you gotta be able to dispatch a team on site to carry out technical due diligence. Now, in some jurisdictions like Australia or Canada, you might be able to put a local team together who can dispatch. That's maybe a little bit easier. In some jurisdictions in Africa or in South America, it might be impossible to carry out meaningful due diligence over the next 2 to 4 months. Yeah, so it's really on a case-by-case basis. I think what it means for our deal pipeline, that one of our force ranking criteria, how we rank the various projects and opportunities that we're pursuing, is our ability to access them for due diligence. Because again, I sound very cynical, but you can never believe what people tell you in mining, because 95% of what you're told is either inflated or is not the whole story. So you just got to look under the hood. And that looking under the hood, that remains to be seen how easy or difficult that's going to be. So if there's anything that concerns me about ability to follow through on deal pipeline, it's ability to carry technical due diligence. We had recently one of our technical operating partners on a site visit, and well, recently, a few weeks ago, still when the world was in lockdown, in relative lockdown. And as a result of a bunch of unlucky coincidences, the guy de facto ended up 5 weeks in quarantine in 3 different countries, just for a 3-day site visit. So I can tell you he's not going to do that again. Yeah. So that remains to be seen with all these travel restrictions. You come back into Australia, you got a 2 weeks in quarantine there, or Peru, Colombia completely shut down. So it remains to be seen how our ability to conduct due diligence is going to look like over the next 2 to 3 months. I would say that's the main obstacle to deal making.
At least you have plenty of time to do your follow-up paperwork after the trip.
That's for sure.
Matt, how is it affecting your pursuit of new opportunities?
Well, look, I think the question is, how does managing an existing portfolio impact your ability to, to pursue new opportunities? Quite honestly, Leo, it's fundamental. It is so important to be an active participant in the mining industry, be working hand in glove with management teams, understanding the pressures that they're under, helping troubleshoot and come up with solutions. The managing your existing portfolio is, it provides you with so much context and ability to both spot, discern opportunity, find good people, see repeat projects. I would say that due diligence is harder. That's causing us to retreat to people that we know well, assets that we know well, countries that we know well. And so, that's probably not a surprise, but we are coming back into the land of the familiar, and with, with a long track record and a lot of people in that area, there's a certain ability to find that opportunity. But you can't look for new opportunities if you're not involved in the game. I'm sure everybody on the call would agree with that, and it's just fundamental being a part of it, because if you lose touch with where the risks are, if you lose touch with reality, pressures that people are facing,
So I think going forward, we'll see more in terms of a PE deal pipeline. You should expect projects to be in WA and in British Columbia and those sort of jurisdictions where there is a lot of expertise on the ground that can do the due diligence. People
I mean, I would say that we're happier to pay more and take less jurisdictional risk right now. As we said, some of that is born out of familiarity. Some of that's born out of the depth of the pipeline that we have. So right now, I feel like a couple things. A lot of our team has been, their engagement levels through tools like Zoom and Microsoft Teams never been higher. Our communications are, again, you can get quite a bit done in this format. But some of what that means is, in this environment, I feel like we're working in dog years, where the intensity of conversations in our pipeline hasn't been this strong as you look back through the sideways market leading into this. There's actually quite a lot to look at still, without branching out and taking on, learning how to invest in a new country or learning how to access a new jurisdiction. I would assume that would be same for most participants, which is that drive towards familiarity in a sea of opportunity. It prioritizes how you force rank opportunity.
Damian, same for you? Is it looking at familiar stuff? And
so it's a very familiar theme. I think what I'd add is the processes we are seeing are being conducted over a longer period of time. You know, so we're certainly seeing processes starting, you know, for asset sales, etc. You know, people getting quite innovative with, you know, drone tours of sites, etc. But, you know, ultimately, you know, we're not going to buy an asset without putting our boots on the ground. So that drives you to sort of, you know, familiar jurisdictions where, you know, you've got experience, etc. And can, you know, get consultants you're close to and your own people on the ground.
Yeah, I would say, Damian, that one thing that's interesting, if you think about some of the expectations that we're seeing, there are a group of people that feel like they can run a regular process, you know, six weeks, 1 month in, and then find themselves surprised when everything is taking longer. So in a piece of advice to people that are looking to access our market, you should expect that it's going to take longer, and you should expect to see CPs or, you know, conditions precedent around the ability to be on site for a meaningful amount of time. And what that means is with an extended process, particularly on an operating asset, you can't, there's just a lot more, pick your partners or your short list, work with them for a longer period of time, and realize that we're going to get to see quite a bit. It's not going to be a snap decision. We're going to be working on this together. So as we go into this deal together, you know, there'll be more time spent on it than you might anticipate, say, a year ago.
And what are your LPs telling you at the moment? What are they saying? Do they want you to get into the market, or are they saying, hold on, put the brakes on?
Well,
go ahead, Bert.
No, I mean, they want, I mean, as a start, I mean, look, let me just summarize as follows. LPs are a bit more liquidity conscious in the current environment than they were before. And that is primarily caused by the catastrophic portfolio performance in the oil and gas private equity space in the US in some funds. So there's a number of situations where very large US oil and gas private equity firms suffered massive losses or need to issue meaningful, very large cash calls to keep their portfolio companies afloat, right? The US, the LPs who underwrite US oil and gas private equity are in many cases the same LPs who underwrite metals and mining private equity. So there's a spillover effect. So what that means is that there is an increased level of awareness or sensitivity towards liquidity issues. For example, you're getting asked, can you just let us know how your cash calls are likely going to look like over the next 3 or 4 months and things like that, which is normally not the case. So there's a bit of more sensitivity on the liquidity out there. But having said all of this, the LPs gave us and the other funds the money to make use precisely of situations like this, right? So the LPs want us as mining funds to go out there and strike deals in the current environment. They want us to do that. So I think mining private equity is not the victim of liquidity sensitivities on the LPs, but we are aware of cases where, for example, oil and gas private equity firms didn't have the cash calls answered and things like that, right? But I think the liquidity constraint in the market on the US LP side is not gonna hit metals and mining private equity.
Do mining private equity funds need to do a good sort of big marketing push towards their LPs to remind them that, you know, if people have traditionally put mining and oil and gas into the same natural resources basket, that now mining and oil and gas are completely separate and on completely separate trajectories going forward?
Well, you can educate them, but they stay in the same bucket. They're in the real asset bucket or in the private equity bucket or in the natural resources bucket. So they stay in the same bucket. If the bucket has a liquidity constraint, there is a spillover effect. So they're going to stay in the same bucket. But I think the education works, you know. I mean, as I've said before, the LPs want us to do deals in the current environment.
Yeah, I mean, but what we were talking about earlier in terms of all of the things that you know, mining, all the materials that mining is going to provide to the sort of the green rebuild, as opposed to, you contrast that with you know, the waning popularity of oil and gas, fossil fuels. They need to be, probably mining needs to be out of that bucket, don't they?
Well, look, I think from a generalist perspective, and most LPs, you know, despite having natural resources. They're allocating across everything. And so what ends up happening is, is this a best idea? Is this best idea wins when they're looking to allocate in an environment like we have today? And so if you step back to a generalist experience, the promise of mining as an investment class hasn't materialized, with a regular, repeatable investment return over the last 4 years or so. So some of the macro, most people that are well educated on the lack of capital formation, the lack of exploration, et cetera. And this isn't just LPs, this is probably the generalist market, where that strong macro piece, as insiders, we look at that and say, boy, this is crazy. There's going to be so much pressure. It should end up in returns, and it hasn't yet. And that's one complexity. The other complexity is that at the moment, just around hydrocarbons, you have a lot of people going through hydrocarbon divestment, and that's merely saying no to a sector. That's too risky. What we have not seen and isn't really in the dialogue yet is a towards anything else. So I think all of us know that energy is a mainstay of life and advanced societies, but saying no to one form of energy hasn't yet shifted towards you're going to need an awful lot of nickel, you're going to need an awful lot of mined materials to support a decarbonized economy. And look, that those macro calls they're not hitting target. I think what is hitting target, if you go back to the very beginning, you got a 2-speed market, you've got gold, you got everything else, and everything else right now, still you're finding absolute value that is really approachable, cents on the dollar, going into capital situations, or NAV multiples that are very, very low, and gold is defensive in people's portfolios. So it's more those aspects that I think are attracting both generalist investors and the people that supply us capital, rather than a macro thematic around hydrocarbon divestment or anything like that.
So gold will be the first thing to bring them. They come for the gold, stay for the renewable metals.
You should run a media empire.
Absolutely.
Yeah.
We do our best. Anyway, so last question. If you are a mining company right now and you are looking to attract some private equity finance, what should you be doing? How should you present yourself?
Okay, well, every fund got a different strategy. So in our case, at the moment, with our remaining capital, we're more pivoting towards producing assets now away from development risk, because we got a lot of development risk on our books already. People should approach us if they have producing assets that require accretive capital for expanding or things like that.
Fantastic.
Or along a life of mine, or to clean up the balance sheet, things like that.
Sure.
But the underlying asset needs to be a decent producing asset.
Sure. Damian, what would you like to see mining companies do?
As mentioned earlier, I think with the exception of gold, where we will look at developed assets, we're really focused on those operating assets, and it's really around capital which will unlock growth in the company, so we can get the volume, increase output, etc. Or a balance sheet which is distressed and needs equity capital to de-stress that. So that's really the kind of opportunities we're focused on. The gold space, we will look at more development assets in addition to operating.
And Matt, what's your take on that?
Well, it's interesting. I believe that growth equity and recap, which the other panelists talked about, those are, a lot of those times those present compelling investment cases. It's also a very competitive source of finance where your ability to go in and do the amount of due diligence and have the value add sometimes is lower, and it's more competitively priced. Some of the areas that we're actually quite attracted to have a lot more complexity around them in terms of not a balance sheet recap or go buy the second asset. Those are great money-making initiatives, but we don't mind getting into the turnaround and partnering with management teams that are in the process of taking a tough situation and trying to make it work. And we'll roll up our sleeves and get right in there.
Mm. And how much money is there available at the moment from private equity for the mining industry?
Ha. Okay, I'm curious what the number is that everybody comes up with. So let's define money first. I define money as capital in institutional mining private equity portfolios that is not yet committed to projects and not yet invested. So I basically dry powder, right? That is can really spent on new deals. So let's define it first. Not a lot. I would say maximum within institutional private equity, maximum $3 billion. Maybe 4 on day. Dry powder. So forget stuff that is already invested or committed to projects. Money that is still, that can be mobilized and invested into new situations. I don't think it's more than 3 or 4. In the institutional metals and mining private equity space. That's my back of the envelope math when I add up all the funds who I know and my estimate how much there is still out there.
Damian, what's your take?
It wouldn't be a number substantially different to that. I mean, I think the only comment I would add to it is that, you know, when we're looking to invest, you know, particularly we will, you know, as we look to buy out situations, right, we'll also look to bring along, you know, look at the debt markets as well. We'll also look to co-invest with maybe pension funds, etc. So, you know, the total capital which you bring to situations is larger, but, you know, if you define it as Bert has defined it, which is what is committed within mining funds today, you'd get to a number similar to what Bert suggested.
Matt, your thoughts?
Yeah, I don't think. Well, I just need to think about it. You know, there's what a dozen, 15 institutional grade, you know, private capital managers, different strategies amongst each of them. You know, you'd have to throw some of the credit funds into that to start to get to the numbers that Bert's talking about. If you step back from structured credit, the number is far, far smaller. But just as Damian said, one of the features now is a drive towards direct from some of the large pension funds. So you're seeing, you know, $200, $300, $400 million coming out of large pension funds, you know, alongside experienced managers taking direct stakes in things. And that's been a trend that has been accelerating over the last little while. So in terms of, you know, formed dry capital, when you got down on the equity side, I'd be surprised if it was $1.5 billion. And then credit markets maybe about that same. Does that feel right to you, Bert? About 50-50 credit and equity. Yeah.
So, no, I excluded co-investment that you can mobilize, right? Yep. So if you include co-investment, then it's maybe $5 billion or so.
Yeah.
So sort of limited money coming out, but all three of you there looking for opportunities. And obviously a lot of opportunities at the moment out there, both in recapitalizations, but also looking towards the future as we come out of the crisis. I think that's probably a good way to wrap things up today. So thank you very much for joining us today. And if any of our viewers would like to get in touch with our panelists, please do let us know and we can connect you up. So thank you very much, gentlemen, for joining us today.
Thank you, Leo.
Thanks, Leo.
Thank you.